Good morning and welcome back to Almus Market Mornings. If markets were hoping for a breather, but that's clearly not the case, because the battleground has now shifted firmly to the Strait of Hormuz, with Iran blocking key shipping routes and the US countering with its own restrictions, keeping the global trade and oil markets on the edge. And hopes for fresh negotiations faded over the weekend as talks failed to materialize, pushing the situation back into a stalemate. And at the same time, rising inflation expectations in the US and the increasing likelihood of Kevin Walsh stepping in as the Fed chair are reinforcing a higher for longer rate narrative, keeping the dollar supported in the near term. And back home, USD/INR has comfortably moved above 94 with persistent importer demand, elevated oil prices, and limited capital flows continuing to weigh on the rupee despite RBI's efforts. Good morning, JK. Given the current stalemate situation and just a lot of back and forth with respect to the war, what do you think the next phase of the conflict would be?
Good morning, Shan. See, I think you can look at it in two ways. You, last week we had quite a few times when hopes were raised about things improving. Initially, it was indefinite extension of the ceasefire by President Trump, which gave some hopes to the market. And subsequently, when the blockade and the Iranian stoppage of ships passing through Hormuz Strait again came into play. Subsequently, later in the week, particularly on Friday, there were hopes again raised about the two parties meeting in Pakistan over the weekend. And in fact, Iranian foreign minister had traveled to Pakistan as well. However, he returned without waiting for US officials to arrive, and he left his demands with the Pakistan, mediators to be passed on to the US. US then stopped their own negotiators from, reaching Pakistan. Latest tweets from Trump says that the war could end very soon and the negotiation could be completed over phone as well. But these are, I think now the market is gone to a situation where it almost not caring for any of the headlines because that's only creating false hopes as well as false moves in the market. And I think we are now in a situation where we will only react if there is a real positive development, sitting across the table and arriving at some peace agreement. Without that, I think market is going to be not very impressed with whatever headlines that are coming out. Now, I think that is why this week market will actually turn its focus to the monetary policies, starting with the Fed rate decision on Wednesday. Of course, before that, we'll also have the Bank of Canada rate decision. Then that will be followed by ECB, UK, and BOJ. All these countries are, facing higher inflation, but at the same time, there should be no change in the monetary policy rate, at least this month, because there is some sort of confidence among the central bankers that this will be transitory kind of inflation, because if the war ends, entire thing can retrace very fast. And with the economy is also slightly fragile, they wouldn't want to tighten the rates in a hurry. So that is where the market is looking out for their forward guidance. And particularly in the US, as you also referred to, we next meeting in May could well be headed by Kevin Warsh, because the his appointment is now almost clear, with the investigation into Jerome Powell's case being cancelled now. In fact, closed actually. So that paves the way for his appointment. Now, whether Kevin Walsh will adopt a dovish approach or not is something that the market is trying to speculate. President Donald Trump has definitely signaled his expectation that Walsh will be swiftly reducing the rates upon taking office. However, the conditions currently do not really support such a move, because the inflation rate as well as inflation expectations have been at multi-year highs, and it's not easy for Kevin Walsh to take a dovish stand. At the same time, there are some indications from him that when productivity linked inflation can actually come down. Rather, the productivity improving can actually bring down the costs and bring down the inflation. So he's trying to create some room for the monetary policy to be kept easy. But at the same time, if the oil prices remain at where they are, it's very difficult for him to even talk dovishly. So of course, it's still some time away before Kevin Marsh will be in office as chairman, because this meeting will be headed by Jayaram Powell, probably for the almost definitely for the last time. And whether he continues after that is again a matter of speculation, but that really does not matter. But if he does relinquish his office as a Fed board member, then it will also pave the way for president to appoint another possible Dow into the board. So, and that could be seen as a negative or dovish for the dollar as well. So the market is looking at these things now, giving less attention to the stop start kind of situation in the war peace talks. Of course, there will be some reaction if the oil once again breaks the 110 level, the Brent oil, but that as of now is holding, probably waiting for some more developments in this regard. So with all this, stock markets have been holding up well, particularly in the EM as well as in Japan. Not really so much worried about the war situation. Perhaps there is some underlying optimism that is driving them. At the same time, the earnings reports from major companies in the US have also been good. So that is at least not giving much of a jitters for the market. Now, all that we need to see is whether Fed once again adopts a wait and watch approach, and that could pave the way for market to gain some more. But again, as they have now been trading at new all-time highs, particularly in the US, the concerns about valuations will arise. So that will keep the market from gaining too far as well. As far as the dollar is concerned, it is very much in the range. Once again, the monetary policy is the focus. Fed probably will not adopt a too hawkish stance. At the same time, with inflation higher in Europe, UK, and Japan as well, even rates there also can eventually go up. If not in this meeting, next meeting, particularly if the oil does not drop again. So that keeps the dollar in a range. All interest surrounds yen, because whenever it is reaching above 159.50, Bank of Japan officials are very coming out with verbal statements, even to the extent that they are saying that they are in close touch with the US officials regarding the forex. If you can recall, last time there was reports that both US and Japanese central bank officials had checked the rates on the yen, and then that is when the dollar yen had fallen to 152. That is one currency that needs to be watched as far as the forex is concerned. As the rupee is concerned, now we are comfortably above 94. All the RBI regulations well discounted, and no real impact, lasting impact of these measures. Even the oil companies are seen to be buying. Of course, it could well be some private oil companies as well. However, the expectation that because of their demand going out of the market, rupee can be stronger has been now negated. So we are well above 94 and could be reaching above 94.50 as well. But that becomes a very sensitive level where RBI, with their now higher reserves, now can be strongly intervening. Whether they will adopt new regulatory measures is something that is a matter of speculation, because so far, whatever they have done, they have not been able to arrest the fall of the rupee. And, any new stronger measures like, import controls or, restriction on outward forward remittances, outward forex remittances will only be resorted to if we see a very steep fall in the rupee, because those will be seen as some sort of regressive measures. But that is something that we can expect if the rupee starts breaking above 95 as well. We did have, of course, official comments about from the uh, Commerce Ministry, saying that, sorry, Chief Economic Advisor, saying that the rupee was fundamentally undervalued, and that at current levels investors could be drawn. But I mean, that just an official view. Markets doesn't seem to be in that mood right now. Last week's stock market had seen outflows from foreigners, as well as the rupee and the stocks giving up their gains as well. So rupee still remains a bit vulnerable, and we watch out for central bank action. Thank you.
Thank you, Jairam sir. And just to summarize, the markets are currently driven far more by geopolitics than pure macro data. And the situation around the Strait of Hormuz remains the biggest overhang, with both US and Iran firmly taking positions with no real breakthrough in talks so far, which keeps the oil prices elevated and supply concerns very much alive still. And this in turn is feeding into the rising global inflation expectations, particularly in the US, where data and forward looking indicators are already pointing toward a more hawkish or at least higher for longer stance from the Fed. And the potential transition to Kevin Walsh as a Fed chair only adds another layer of uncertainty around the future rate paths. And despite all this, the equity markets have shown some resilience, supported by earnings and valuations, especially in select emerging markets and Japan. And however, in currencies, the story is different as the dollar remains supported and the yen continues to be closely watched near intervention levels. And when it comes to USD INR, the rupee is sustained its pressure with USD INR holding above 94, driven by stronger importer demand, elevated crude prices, and a meaningful lack of meaningful capital inflows, even as RBI interventions had only a temporary impact in the short term. Thank you all so much for listening, and we'll catch up tomorrow with a fresh round of updates. Thank you.